You know, every single day, businesses are making thousands of little decisions. But how do they actually know if they're winning or losing? Well, the answer lies in this really powerful and surprisingly ancient tool that translates every single action into a clear financial story. So let's get into it and break down the language of business, bookkeeping.
Okay, let's start with the most basic question that every single business owner has to ask themselves. I don't care if you're running a massive corporation or just a local coffee shop, how do you really know if you're on the right track?
The answer? You need a scoreboard, a financial scoreboard. Think about it. In business, every single transaction is a play. Your income, that's you scoring points. And your expenses, well, those are the points scored against you. Bookkeeping is the system that keeps track of every single one of those plays, giving you a crystal clear picture of the final score.
But here's the thing that might surprise you. This whole idea of keeping a financial score, it's not new at all. In fact, it's a really ancient innovation. It's a solution to a problem that people have been trying to solve for thousands of years.
I mean, just look at this timeline. It's incredible. It goes all the way back to ancient India, where early texts were already talking about how important it is to keep records. Then you fast forward to the 12th century, and boom, we see the first mention of debits and credits. But the real revolution, the game changer, came in 1494. An Italian merchant, Luca Pacioli, introduces this thing called the double entry system. It's this beautiful, elegant idea that for every transaction, there are two equal and opposite entries. It created a self-balancing system that is, no joke, the foundation of all modern accounting. And then, of course, the Industrial Revolution came along and just supercharged the whole thing for the massive companies that were literally changing the world.
So we've got this ancient practice that's evolved over millennia, but what does that actually mean for a business right here, right now? Let's nail down exactly what we mean when we say bookkeeping in today's world.
To put it simply, bookkeeping is just the organized, systematic recording of every single dollar that comes in or goes out. But it's not just about jotting down numbers. It's about classifying them, organizing them, so that later on you can look back and see the entire financial story of your business. I absolutely love this quote from J.R. Botleboy. He calls bookkeeping an art. And it really is, isn't it? It's the art of taking all the chaos of daily business deals and turning it into something clear, orderly, and, well, meaningful.
So this art isn't just about being creative, it's also a science. There are some really key features that make it all work. First, it's got to be systematic. Second, it only deals with money, no feelings, just finances. Third, it's based on rules, on established principles. And that's exactly why it's often called a scientific art. It's this perfect blend of precision and skillful application.
All right, so we know what bookkeeping is, and we know kind of how it works. But why bother? What's the end game for all this careful recording? Let's dig into the why behind the what.
Okay, the main goal here is to build a complete and totally accurate financial picture. And this isn't just a quick snapshot either. We're talking about a permanent record. It's so reliable it can actually be used as evidence in a court of law. And with that picture, a business can finally truly see if it's making a profit or a loss. It can understand what it owns versus what it owes, and it knows exactly who owes the money and who they need to pay.
But here's where it gets really interesting. This financial picture isn't just for the owner to hang on the wall. Its impact creates this massive ripple effect that touches way more people than you'd think. So, who else really cares about a company's books?
Well, take a look at this. It's pretty telling. Of course, the owners and the management team are the biggest users. That makes sense. But check it out. Investors, lenders, the government, and even customers. They all have a stake in a company's financial health, and they're all relying on these records to get the real story. For the people actually running the show, the owners, the managers, this information is basically their GPS. It's their navigation system. They use these financial reports to plan where they're going, to make those tough decisions, and to keep control of the entire operation. Without it, they're just flying blind. And for everyone else? Well, they're asking different questions, but the answers are still hiding in those same books. An investor's thinking, is this a smart place to put my money? A bank is asking, if I lend them cash, will I get it back? The government, of course, needs to know how much tax to collect. And hey, even you, as a customer, might wonder, is this company stable enough to be around next year to honor my warranty? The financial records hold all those answers.
So at the end of the day, bookkeeping does one incredibly powerful thing. It translates actions into a story. It's never just about the numbers themselves. It's about the narrative they reveal, a story of success, of struggle, of strategy. So the final question really is for you to think about. What story are your numbers telling?
All right, let's jump right in. Today we're breaking down something that is the absolute bedrock of any business, whether it's a tiny startup or a huge corporation, the difference between bookkeeping and accountancy. You know, getting this right is just fundamental, so let's get into it.
Just think about it for a second. Every single day in a business, you've got money coming in, money going out. Sales, expenses, payroll, taxes, it's this constant river of financial activity. So the big question is, how do you keep track of it all? And even more importantly, how do you turn all that chaos into smart decisions? Well, that's exactly what we're going to unpack.
You know, at its core, the difference really boils down to this one simple but really powerful idea. Bookkeeping is all about recording what has already happened. It's the history book of the business. Accountancy, on the other hand, takes that history and uses it to analyze, interpret, and help plan out the company's future. So one is looking backward, and the other is using that information to look forward.
Okay, so let's start at the beginning, with the foundation. The absolute best way to think about bookkeeping is to imagine it as the business's daily financial diary. Its job is to capture every little detail, every single day, no exceptions.
Right, so the official definition has two key words, recording and classifying. And that's really it. A bookkeeper's job is to see a transaction, say you buy new laptops for the team, and then record it properly. They classify it as an asset, they note the date, the amount. It's all about being incredibly systematic and precise.
Bookkeeping is what we call the primary stage. It is the foundation that everything else in accounting is built on. The main things it produces are the journal and the ledger. You can think of the journal as a day-by-day list of every single transaction as it happens. And the ledger? That's where you sort all those transactions into categories, like sales, rent, or office supplies. This becomes the raw data for the entire business.
And that's the most important thing to remember here. Bookkeeping is purely descriptive. All it does is answer the question, what happened with our money today? It's not there to analyze anything, it's just there to record the facts cleanly and accurately.
So you can see the flow, right? A customer buys one of your products. That's step one, the transaction. The bookkeeper records that sale, step two. And for the bookkeeper, their main job is done. But for that piece of data, its journey is really just getting started. So let's see where it goes next.
Okay, so if bookkeeping is like writing all the individual diary entries every day, then accountancy is the author who takes that diary and writes the company's official biography. The accountant finds the patterns, pulls out the major themes, and tells the big picture story.
You know, this quote from Professor Robert N. Anthony just nails it. Accounting takes all that raw data that the bookkeeper collected, and then, here are the key words, it summarizes, analyzes, and reports on it. It's a much more active, interpretive process.
So, while bookkeeping gives us the raw journal and ledger, accountancy gives us those big picture financial statements that you've probably heard of. It creates the profit and loss statement, which tells you if you actually made money, and the balance sheet, which is like a financial x-ray of the company at one specific moment in time. These are the real tools for strategic thinking.
I absolutely love this way of putting it. An accountant looks at everything the bookkeeper recorded and asks, so what? So what if our sales went up? Our costs went up even more? Or what is our cash flow telling us about whether we can afford to hire new people next quarter? It's all about turning that raw data into actual, usable insight.
And when you put them side by side like this, the difference just becomes crystal clear. Bookkeeping is absolutely vital, but it doesn't really require deep analytical skills. Accountancy, on the other hand, is all about analysis. That's why bookkeeping is often a more junior role, while accounting is a senior one. And here's the bottom line. Management can't make big strategic decisions based on raw bookkeeping data. They need the analyzed reports that an accountant creates.
Now, all of this recording and analyzing, it's not just a free-for-all. There are very specific rules of the road that everyone has to follow. This ensures that all the information is consistent and, well, reliable. Let's take a quick look at the two main ways it's done.
Okay, this is a really important distinction. The cash method is super simple. You record money when it actually hits your bank account, and you record an expense when the money actually leaves. Simple, but most businesses use the accrual method. With accrual, you record revenue when you've earned it, even if the client hasn't paid you yet, and you record an expense the moment you incur it, even if you haven't paid the bill yet. It gives you a much more accurate picture of your financial health.
So we've got all this data being recorded and analyzed, and it's following specific rules. But what actually makes that information good? What makes it useful for anything? Well, that all comes down to a few key qualities.
It's a great question, isn't it? I mean, just having a bunch of numbers on a page isn't enough. For a CEO or an investor to actually bet the farm on these reports, the information itself has to meet some pretty high standards.
And these are the 4 pillars that make it all worthwhile. For any financial statement to be truly useful, the information has to be reliable, relevant, understandable, and comparable. Let's quickly break down what each of those really means.
First up, reliability. This is the foundation of trust. It means the information is totally objective, it's free from any bias, and you can verify it. An auditor should be able to look at a number on a report and trace it all the way back to the original receipt. It has to be trustworthy.
Second, the information has to have relevance. It needs to actually matter. Does this piece of data help you make a decision about the future, or does it help you confirm if a past decision was a good one? If not, it's just noise, and it can actually get in the way of making good choices.
Third is understandability, and this one is huge. The information has to be presented clearly and concisely, so that someone with just a reasonable knowledge of business can look at it and get what it means. A report that's technically perfect but impossible to understand is, at the end of the day, completely useless. And finally, we have comparability. This just means you're using the same methods over time. This is what lets you compare apples to apples, so you can see how your company did this quarter versus last quarter, or how your business is doing compared to your biggest competitor.
And this really brings us to the single most important takeaway from all of this. All that high-level analysis, all the incredible insights, all the big strategic decisions. Every single bit of it is built on a foundation of accurate, systematic, and reliable bookkeeping. You just can't have good accountancy without good bookkeeping. If the daily diary entries are wrong, the final biography is going to be a work of fiction.
So let's end with this thought. Bookkeeping is what provides all the individual words, the sales, the costs, the assets. Accountancy is what takes those words and arranges them into sentences and paragraphs to tell a story. So the final question for you is, what story is your business telling?
Hey there, and welcome. Today, we are going to crack the code on the language of business. You know, it's the language that can take a brilliant idea and turn it into a real, breathing company. So, whether you're dreaming up your own startup or you're just curious about how businesses actually work, you are in exactly the right place. So, have you ever heard words like creditors, debtors, or capital expenditure and just kind of zoned out? Yeah, you are not alone. It can totally sound like a completely different language, but I promise you, once you get the hang of a few keywords, this whole world of business just clicks into place. And to make this super easy and, actually interesting, we're going to follow a story. Let's meet Anna. She's about to open her dream bakery, and by tagging along on her journey, we're going to see exactly how all these big financial ideas play out in the real world. Okay, so every business story starts with that spark of an idea, right? But that spark can't really catch fire without some fuel. And for most businesses, that fuel is the initial investment. It's the seed money that gets the whole thing off the ground. Think about it. Before Anna can sell even one single croissant, she needs an oven, she needs a cash register, she needs tons of ingredients. So the money she puts in herself to buy all of that stuff, that's her capital. It's really the foundation that the entire business is built on. All right, the bakery is all set up. You can smell the fresh bread wafting down the street, and Anna is flipping that sign to open for the very first time. This is where the action really begins. In the business world, the word goods is basically anything you buy or sell. For Anna, this means the obvious stuff, right? Her delicious pastries and loaves of bread. But it also includes the raw materials she needs to make them, like all that flour and sugar. It's literally the stuff her business runs on. Okay, so anytime money changes hands or is even just promised for later, that's a transaction. It's a two-way street. A customer buys a loaf of bread from Anna, that's one transaction. Anna buys a giant bag of flour from her supplier. Yep, that's a transaction too. Now, transactions really come in two main flavors. You've got your cash transaction, which is super simple. A customer pays Anna, she hands them a coffee. Boom, done. Instant exchange. But then there's the credit transaction. Let's say a local office orders a huge catering tray of pastries. Anna delivers them with an invoice, and that office says, "We'll pay you next month." See, that's a credit transaction. So in that exact situation with a catering order, that office has just become Anna's debtor. A debtor is just anyone, a person, another company, who owes your business money. They've got your goods, but you don't have their cash. At least, not yet. From Anna's perspective, it's pretty straightforward. That unpaid invoice means the office is on her debtor list. And let me tell you, for any business, keeping a close eye on who owes you money is absolutely crucial for survival. But like we said, it's a two-way street. Anna also buys things on credit. And the person or the company that she owes money to, that's her creditor. This is usually a supplier who's given her goods with the understanding that she'll pay them back soon. So, here's Anna's side of that coin. She just got a huge shipment of flour to keep the bakery going, but she hasn't paid that bill yet. Until she does, that big flour company is her creditor. Makes sense, right? So, with all this money and all these goods flying in and out, how on earth does Anna keep track of everything? Well, this brings us to the super important practice of bookkeeping. Every single one of those transactions, every coffee sold, every bag of flour bought, has to be recorded. In the world of accounting, that simple act of just writing it down in the official records is called an entry. It's the basic building block of a company's financial story. But numbers alone don't really tell you the whole story, and that's where the narration comes in. It's just a quick little note that explains the why behind the numbers, something like, for the catering order delivered to the local office. It gives context, which is so, so important. Of course, running a business isn't just about the money coming in, right? It's also about all the money going out. But as we're about to see, not all spending is the same, not by a long shot. The general kind of fancy term for any money spent by the business is expenditure. But if you really want to understand if a business is healthy, you have to split this spending into two very different buckets. And this is a huge one, so listen up. First, you have revenue expenditure. This is all the day-to-day stuff that keeps the lights on. Anna's rent, her employees' salaries, the flour she buys every week. Then you have capital expenditure. This is about investing in the future. So when Anna buys a massive new oven that's going to last for a decade, that's a capital expenditure. One is about running the business, the other is about growing the business. Okay, but what happens when Anna needs to pay her own rent at home? When a business owner takes money out of the company for personal, non-business stuff, like paying her son's college fees, it has a special name: drawings. And it's really important to keep track of this separately from all the other business expenses. All right, let's get into some of the nitty-gritty of managing all this cash flow. We're going to look at how businesses use discounts to their advantage and what happens when a debt, goes bad. So businesses usually offer two main types of discounts. First is a trade discount. This is for buying a lot of stuff at once. If a local cafe orders 100 croissants, Anna might give them 10% off right there on the spot. But a cash discount is different. It's a little reward for paying your bill early. She might tell that office client, hey, if you pay this invoice in 10 days, you can take another 2% off. It's a clever way to get your cash faster. And now for the painful side of selling on credit. What happens if that office client suddenly goes out of business and never pays Anna? That unpaid invoice now becomes a bad debt. It's money she earned, but will just never see. It's a tough pill to swallow, and it has to be recorded as a loss for her bakery. Phew! Okay, let's do a super quick recap of our Founder's Dictionary. Capital, that's your starting cash. A transaction, any swap of money for goods. A debtor owes you money, you owe a creditor money. And expenditure is just all the cash going out the door, either for daily costs or big investments. You see, these aren't just boring accounting terms. They're the actual words that are used to write the financial story of any business. And that could include your own someday. So now that you know the language, what kind of story are you going to tell?